Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. Weather concerns, planting delays, and a weaker dollar seem to be at the heart of what is causing potential support in the corn market. We've had about 360 as our line in the sand for key support for the July contract, and as we can see here, that 360 mark has held up really well. The market came in, and the first time it tested, the market bounced up from just above 360. And just a couple days ago, the market once again made a push down to close to 360 and bounced up from there. We're currently sitting at a couple key levels that we want to monitor as the market now progresses. As well, we have first notice day for the May contract coming up this Friday. Right now, the point of control sits at 372, and the market today has made its way above that level once again. As long as this market can find its way to stay above 372 this week, we believe that the market could very well be on its way up to 400 and potentially as high as 405.50. But for now, 400 is the price threshold that we're looking for the market to reach by mid-June. From this perspective, we can see some very key indicators at work. First, I'd like to take note at the volatility-based support level that came in just above and below 365.5. This is where the market tested a couple times and has found very good support, and from here the market has been able to make its way up. Additionally, we have our sinusoidal wave action coming in, and the market has touched this area here as it did before and has bounced off that level very well. Thirdly, we can see the market also bounced off of the 45-degree mark, and that 45-degree mark lands at 365.5. So all of these components coming in suggest that the market looks to find very good support near the 360 to 365 area. And now we're up and moving our way toward 375, which is our 360-degree mark. And again, if the market's able to close above 375 this week, we feel very confident that the next areas that the market would look to test would first be 384 and 3/4 or 385. And beyond that, the market would then have a very good chance of making its way up to about 400. As has been suggested previously, part of the movement that we're looking at is for the market to continually make higher highs and higher lows as it looks to make its way up to about 400. If the market is able to do that, even if you had not been able to enter the market early on this move off of a bounce, it could very well give you opportunities at subsequent dips as the market makes its way up, and to give us some good spots to actually put some stops in the market as well, as to not expose ourselves to unnecessary risk. The December contract has a similar formation. In fact, the December contract looks to be a little bit stronger. In the July contract, the market actually made a slightly lower low compared to the low that was made in March. In this scenario here, the actual low that came in a couple days ago was actually higher than the previous March low, suggesting that we have a little bit more legs here as the market sits right on top of one of our point of control levels. Here we can see that the point of control sits at 386, and at 386 we can see this is where support came in very well. Up from 386, the market now is poised to make its way up to 410 potentially, and 410 is a long ways off, so similar to the July contract, we would be looking for sequential higher highs and higher lows. Here we can see some key indicators at work. First, we can see volatility-based support once again came in very well. The 180 and 360-degree levels are often key areas of support and resistance for the market to make potential reversals. And after having bounced off of the 180-degree mark a couple times, the market is now poised to make an advance up to about 402.5. And if we close above 392.5 this week, that is a very good sign. And from there, we would be looking for the market to find potential resistance at volatility-based resistance up in the area of 400 to 404. Moving on to soybean, we can see here that the market has actually posted for us two key impulse moves. The first impulse move I'd like to bring to your attention is the move from the high back in January down to the low that comes in March. The market here produced a mirror move after a continuation pattern suggesting that the market would look to break down from this area. In doing so, what we'll notice is that the market produced a mirror move from the next subsequent high down to the next major low that was a match of the move from the previous impulse move. It did it again from the recent move that we saw, where the market actually made a move from this recent high down into another continuation pattern, and we can see once again the culmination of this final low coming in at two key mirror opportunities. With both of these legs terminating at a common area, this suggests that this low could very well be a very significant low. The caveat, though, is that the market is now approaching being overbought, meaning that the market has now dropped and has made a pullback, yet over the course of the last several days, the market has yet to be able to eclipse the same range that it did on the way back down. So right now, what we're looking at is the potential for the market to make one more leg down, but as long as the market's actually able to continue to hold here, and perhaps if it's able to just simply churn around our point of control level near 960, this would be an indication that a potential change in trend is occurring, and instead we could see a slightly higher low, enabling the market to start to make its way back up again. But again, it's important to notice that the market is overbought, and one more leg down should not come as a surprise. And so right now we simply want to sit on our hands and allow the soybean contract to materialize and to show more definitive confirmation as to where the direction may lie right now. Like corn, soybean is sitting right inside of our volatility-based support band. And now the market finds itself in a situation where it's finding potential resistance up against the 360-degree mark at 983.5. If we're able to get above this 983.5 number this week and to close above this number, we could very well be on our way to making a move up to our target of about $10. We also see that our volatility-based resistance band has made a very big shift to the downside, suggesting that we're going to find very good resistance near that $10 mark. And so again, even if the market were to make its way up to about $10, getting much higher than that looks to be quite a bit of a challenge. We have a similar formation here for the November contract, so we will simply highlight some of the key levels to keep at the forefront of your mind. Down below, we have our point of control levels situated right at 955. This is the area where the market finds itself really finding very good support. The market then can find its way to bounce up, and the next level then sits at $10.05. We can also see that the downside 1-by-1 angle is posing reasonable resistance for this market on the way up. And from here, we would like to see soybean eclipse this level to give us a true indication of potential strength. Here we can see that we found very good support at the volatility-based support zone. The market made its way up to the 180-degree mark at 964.75. And from here, we would look for the market to potentially find very good resistance in the event that it makes its way up to about $10, which should coincide with volatility-based resistance overhead. The market now has a couple levels in between before getting there. We do have 980.25 and just above that 995 or 996. Moving on to the wheat contract, we shared a price objective of 420 for the wheat contract, and the market did not disappoint. After having been overbought, the market made a very big move to the downside, came down just below 420 to about 418, and has since bounced in conjunction with the market being oversold. So as we can see here, the trade opportunity to have taken this short off of very good resistance that culminated after the market made its way up to being overbought, came down to our price target, marginally breaking the previous low, giving us a significant spot here. And we can also take note that the market has given us a very clean 5-wave Elliott sequence. Coming off of this high, we have wave 1 coming in, a bounce up to wave 2, a very clean wave 3 down, a sideways wave 4 with a final move down to wave 5, suggesting that this bounce up could be of significance where this market can give us an ABC correction where we could see a nice leg up perhaps to retest that previous wave 4, where the market could move up from here and terminate a wave A just at about the 440 mark, then perhaps to give us a higher low coming in at about 425, and then give us one final C leg that eclipses that previous top just beyond 450 to give us a clean ABC movement on the way back up. And after giving us this ABC movement, we could very well be on our way down again. But that remains to be seen, but we simply wanted to share with you one of the possible formations that can occur going forward. The top that was reached about a week and a half ago again coincided with our sinusoidal wave level. The market made a very nice decline to the downside, coming in at that 420 number that we suggested, and that level also now has become volatility-based support, suggesting that this low can hold for about 6 to 8 trading days at a minimum. Crude oil continues to move in concert with expectations. We saw the market came in last week or about a week and a half ago, where it was overbought, suggesting that the market was poised to make a move to the downside. We have also taken a measurement from the previous low up to the nearby high, and this retracement actually lands right at 78.6%, which is a Fibonacci factor, landing at 48.98. This low, therefore, suggests that the market can find a small bounce here in conjunction with the market being oversold. Now, if this level is not able to hold, then the market is actually poised to actually make its way down and test 46.25 at a minimum. And so this level here at 48.98 is going to be very key as to whether or not this contract could hold on. If this 48.98 level does in fact hold, then what we would anticipate is a potential retest of the previous high near 53.50 or so, at which point the market would produce for us a lower double top, giving us one more final leg down for a nice clean drop in this crude oil market. Thank you so much for joining us for our weekly market update, and look forward to touching base with you again next week.